This week has been a hot one around the country. Fortunately, today brought colder weather here in New York, but it also brought a colder than expected jobs report. Here is what you need to know. The U.S. economy added 73,000 jobs in July, falling short of expectations. However, the most eye-catching news came from the downward revisions, which removed 258,000 jobs from the prior 2 months. Outside of the pandemic, this was the largest downward revision since at least 2013, and they really took the wind out of the labor market sails. On average, over the past 3 months, non-farm payrolls rose by just 35,000. That is down from 127,000 in April. Now, across sectors, job growth remained concentrated in services, with healthcare and social assistance driving the bulk of these gains. Goods-producing sectors lost 13,000 jobs for the third consecutive month, while government employment fell by 10,000 jobs. The unemployment rate rose to 4.2%, and was just a few decimals away from rounding up to 4.3%. This occurred even as the labor force fell, with unemployment rising by 221,000. Changes here will be scrutinized in the coming months, as Chair Powell noted that the unemployment rate is the main measure used by the Fed to assess labor market balance. Now, in response to today's weaker report, investors are now pricing in an 88% chance of a September rate cut, up from 40% at yesterday's close. We agree with the sentiment, but aren't completely convinced about a September cut, as the Fed will also have to consider the risk of delayed tariff-related inflation. Should the August jobs report show stable unemployment, the Fed may feel comfortable holding steady as tariffs continue to pressure inflation higher.